Hey Rise family, I hope you guys had a wonderful weekend, and today, as promised, I want to share with you the most common piece of resistance agents get from current homeowners. And that is they're simply married to the interest rate. And what does that do to those homeowners? Hey agent, I would love to move out of this house. I have 4 kids now. We need a 5-bedroom, but I got a 3% interest rate loan. Hey guys, I know this house is too big for me. I would love to downsize and move closer to work, but I got a 3% interest rate and I cannot fathom taking on a 6% or a 7% interest rate loan. Well, you know what? That's the most common piece of resistance we're seeing right now. But when you connect that particular homeowner for a no obligation consultation with a lending partner like myself, we're gonna look big picture. We're gonna look at the whole holistic profile. There's no money up front. It's a soft, if we do pull credit, it's a soft credit pull at the beginning stage. And what we're looking at is the holistic picture. What's really going on in the client's life? Not just about, well, we got a 3% interest rate and we're taking it to 6. We're looking at everything. And so a lot of times what we're seeing is we're seeing a customer that is stagnant. They're not moving forward. They can't leverage their equity because they're stuck on this low interest rate. And what we're seeing is we're seeing credit card balances. These credit cards are now in the 20–25% interest rate range. We're seeing automobile payments, whether they're lease payments or finance, there's still an interest rate attached to them. And right now we're seeing the 7–9% interest rate range on automobiles. And then we're also seeing customers' businesses, maybe a business line of credit that just hasn't been paid off yet, or an SBA loan. These loans also are not cheap. By educating the seller or the potential seller that they could sell, take this equity that they've gained over the last handful of years, consolidate their debts into one mortgage payment, we can identify the 24%, the 10%, and the 7% and average that out to see what their current rate of interest is on a holistic basis compared to what it could look like by having one mortgage payment. So we're taking a 3% mortgage, 25% credit cards, and averaging that out with their other debts to identify that sometimes they're in the 9–10% rate of interest. So not only can we reduce the average rate of interest that they're borrowing by consolidating into one new loan property, but we also can look at the re-amortization of debts. So SBA loans and business loans are typically 20-year amortizations. Credit cards are neg-am basically. And then some of these customers that got a mortgage they've had this mortgage where they have 25 or 20 years left on the mortgage. We're gonna stretch that back out to 30 on a new mortgage. So we can actually help improve their household cash flow by putting them into a new property and a new loan. So guys, if you have any questions of how this might be applicable to you or your clients, reach out. We have fancy software that we use to input all the debts and all the interest rates in, and we can share this on a link that we could have on an iPad at the client's house, or even on your phone where you can kind of scroll and look at the data with the client right there on the fly. So look forward to it. Make it a great day, and I'll talk to you soon.